Visa Inc., stock ticker V, is a multinational financial services corporation. Founded in 1958, Visa is now a $485 billion by market cap digital payments giant that employs more than 26,000 people. Fiscal year 2022 revenue breaks down across the following four segments: data processing revenues 49%, service revenues 46%, international transaction revenues 33%, and other revenues 7%. Client incentives, a contra revenue item which accounted for 35% of reported fiscal year 2022 GAAP revenue, explains why the main four segments add up to more than 100%. Visa runs a simple to understand business model, but this simplicity makes it no less powerful, beautiful, or compelling. To the contrary, many of my best investments over the years have been with boringly simple businesses. Essentially, Visa operates a global open-looped network that enables electronic payments for consumers, merchants, and governments. Put simply, Visa facilitates easy digital payments, collecting a small fee from every digital payment it processes. Instead of cash, payments are able to easily and safely be handled by way of a Visa card on Visa's payment network. In fact, Visa operates the largest such digital payments network in the world. To put this in perspective, the company's processing infrastructure, VisaNet, processes more than 600 million transactions per day. The company is processing around $15 trillion in total volume annually. Another mind-blowing number is 3.3 billion, which is approximately how many Visa cards are in global circulation. It's estimated that Visa has a 50% share of the global market, easily pinning it as the worldwide leader in digital payments. What's even more amazing is that Visa might just be getting started. Up until very recently, cash was still the dominant form of payment for global transactions. Morningstar notes, and I quote, "Digital payments on a global basis surpassed cash payments just a few years ago, suggesting this trend still has a lot of room to run," unquote. Since digital payments are superior to cash payments in almost every single way, it makes sense that cash is slowly being phased out. That conversion from cash to cards bodes incredibly well for Visa. The company will likely continue to process the lion's share of global payments. Furthermore, with inflation recently running hot and causing the cost of almost everything to go up rather significantly, Visa's fee base is rising in kind. The annual rate of inflation in percentage terms has been slowing, but the new higher cost base of almost everything is already firmly entrenched, which boosts Visa fees in absolute terms. It's a permanent, quote-unquote, step up for Visa. All of this is why the company has such a long and wide runway for revenue, profit, and dividend growth. Already, Visa has increased its dividend for 15 consecutive years. That dates back to Visa's 2008 IPO. The 10-year dividend growth rate is 20.3%, which is obviously exceptional. But what's especially exceptional about it is there's been no measurable slowdown. The most recent dividend raise was 20%, yet the payout ratio is only 24.1%. That tells us two things. First, we can surmise that much of this high-octane dividend growth has been fueled by similar earnings growth. Otherwise, the payout ratio would already be very high. Second, and related to the first point, it's reasonable to expect this approximate 20% dividend growth rate to persist for a while longer. It's pretty clear that this is one of the safest and fastest growing dividends out there. Seeing as how the stock's yield is only 0.8%, that's good news. Now, this yield is 20 basis points higher than its own 5-year average. Nonetheless, you really do want to see a higher dividend growth rate in order to make sense of a low yield like this. For younger, long-term dividend growth investors who love compounders, Visa is clearly very appealing. Looking at business growth, Visa advanced its revenue from $11.8 billion in fiscal year 2013 to $29.3 billion in fiscal year 2022. That's a compound annual growth rate of 10.6%. Excellent top-line growth. I usually look for a mid-single-digit top-line growth rate from a fairly mature business like this. Visa knocked it out of the park. Meanwhile, earnings per share grew from $1.90 to $7 over this period, which is a compound annual growth rate of 15.6%. Superb. A combination of margin expansion and share buybacks drove a lot of this excess bottom-line growth. For perspective on the latter point, Visa reduced its outstanding share count by roughly 17% over this 10-year period. Looking forward, CFRA is projecting an 18% compound annual growth rate for Visa's earnings per share over the next 3 years. I see nothing unreasonable about that. This isn't far off from what Visa has clearly proven to be capable of producing. The pandemic disrupted Visa for a bit. Of course, the pandemic was something that all businesses had to contend with, but Visa's exposure to cross-border travel means that Visa took took an outsized hit. However, travel is on the mend and roaring back, and all of the trends that work to Visa's favor are firmly in place. The cash-to-card conversion is going to be playing out for years to come, and inflation has been a boon. If, for example, something that would have cost say $5 a few years ago now costs say $6, Visa now collects a fee from a $6 transaction rather than a $5 transaction. That's automatically more fee revenue, yet Visa incurs no additional costs for the facilitation of the transaction. The scalability is out of this world, and the business model is about as good as it gets when it comes to hedging inflation. If we take CFRA's forecast as the base case, that puts Visa in a great position to grow the dividend at a similar rate. After all, the payout ratio is still quite low. This perfectly circles back around to what I noted earlier about it being, quote, reasonable to expect this approximate 20% dividend growth rate to persist for a while longer, unquote. Now, a while longer doesn't mean forever. At some point, Visa will have to start moderating the rate of dividend growth, but I don't think that point is on the horizon. With the business and dividend growth at a rate of somewhere around 20% for the foreseeable future, you can easily start to picture an annualized total return somewhere in that same vicinity. Visa has been, is, and should continue to be a total return monster. Moving over to the balance sheet, Visa maintains an extremely strong financial position. The long-term debt-to-equity ratio is 0.6, while the interest coverage ratio is over 35. Good numbers, but they're better than they look. That's because Visa has enough cash on the balance sheet to nearly wipe out all long-term debt. Net debt is barely over $0. Visa's balance sheet, quite simply, is a fortress. Profitability is outstanding. Over the last 5 years, the firm has averaged annual net margin of 50.5% and annual return on equity of 38.9%. Visa has some of the highest returns on capital of all businesses I've ever looked at. From top to bottom, Visa is a world-class business that is operating at a very high level. And with brand power, a huge network effect, built-out global infrastructure, global market share leadership, easy scalability on industry-leading scale, and high barriers to entry, the company does benefit from durable competitive advantages. Of course, there are risks to consider: regulation, litigation, and competition are omnipresent risks in every industry. Regulatory headaches have been increasing for Visa. On the other hand, seeing as how Visa operates within the favorable confines of a global oligopoly, there are only 4 large global payment networks, competition is limited. Visa is exposed to broader economic trends as its fee base is directly tied to global spending. Any kind of recession would likely impact Visa. Being a global payments operator, Visa naturally has exposure to geopolitics and different currencies. The company's large size is a risk, as the law of large numbers could start to be a drag on relative growth. There's technological risk present, and any major change in the way payments are handled would be a threat to Visa's business model. I don't view these risks as too much to accept, especially when lined up against the immense quality of the business, and with the valuation being modestly attractive right now, this could be a rare buying opportunity. The stock's price-earnings ratio is 32.4. Is that egregious for one of the best businesses in the world? I really don't think so. Keep in mind, this stock usually commands a hefty premium. Its own 5-year average PE ratio is 35.6. The price-to-sales ratio of 16.5 is also below its own 5-year average of 18.1, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a 2-stage dividend discount model analysis. I factored in a 10% discount rate, a 20% dividend growth rate for the next 10 years, and a long-term dividend growth rate of 8%. These are admittedly aggressive numbers, but if there's any business that deserves the benefit of the doubt, it's Visa. The demonstrated long-term dividend growth rate is approximately 20%. The most recent dividend raise came in at 20%. We can see a near-term forecast for underlying EPS growth at nearly 20%. The payout ratio is very low, and the balance sheet is stellar. Visa may not grow the dividend at exactly 20% over the next decade, but it's also quite possible that this elevated state of dividend growth exists for a period that extends well beyond the next decade. Overall, Visa is one of the best businesses I've ever seen, and I don't think high expectations are unreasonable. The dividend discount model analysis gives me a fair value of $262. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates V as a 3-star stock with a fair value estimate of $241. CFRA rates V as a 4-star buy with a 12-month target price of $272. A decently tight range here, averaging the three numbers out, gives us a final valuation of $258.33, which would indicate the stock is possibly 6% undervalued. Here's the bottom line, guys. Visa Inc. is a world-class business with high returns on capital and a fortress-like balance sheet, and it's benefiting from one of the strongest secular trends out there, with a competitive yield, a double-digit dividend growth rate, a very low payout ratio, 15 consecutive years of dividend increases, and the potential that shares are 6% undervalued. Long-term dividend growth investors who want to own a slice of one of the best businesses on the planet ought to be taking a close look at this one. And now for a special news announcement. Domino's Pizza Inc., stock ticker DPZ, saw its stock soar on the back of an announcement that the company entered into a new global agreement with Uber Technologies Inc., stock ticker UBER, which allows US customers to order Domino's products through the Uber Eats and Postmates apps. This opens up even more customers for Domino's. We recently covered this name as an undervalued high-quality dividend growth stock to consider. Those who complained about the valuation in the low 300s are now likely complaining even more, and they'll still be complaining when it's at $400, $500, etc., because Domino's is almost certainly headed a lot higher over the coming years. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.